Launching off with adjusting entries. Adjusting entries are needed to ensure that the revenue recognition and expense recognition principles are followed. They are required every time a company prepares their financial statements, and they always include one financial statement account and one balance sheet account. Before adjusting entries, the trial balance may not contain up-to-date and complete data for quite a few reasons. Some events are not recorded daily because it's not efficient to do so. Some costs are not recorded during the accounting period because these costs expire with the passage of time, rather than as a result of recurring daily transactions. And some items may not have yet been recorded. Now, are adjusting entries made to ensure that expenses are recognized in the period in which they are incurred, revenues are recognized in the period in which the performance obligation is satisfied, the balance sheet and income statement accounts have correct balances at the end of the accounting period, or all of the above? Correct. It is absolutely for all of these reasons that adjusting entries are made. We began talking about adjusting entries by talking about the deferrals and accruals. Let's look at those at a high level. So deferrals are prepaid expenses. Expenses paid in cash and recorded as assets before they're used or consumed, or unearned revenues, when cash is received before a service is performed. And accruals are accrued revenues. Revenues for services performed but not yet received in cash are recorded. And accrued expenses that are incurred but not yet paid in cash or recorded. Remember, the trial balance confirms that all the debits equal the credits. But because some of these transactions may not have been recorded yet, does not mean that it is automatically up to date. Each account in a trial balance is analyzed to determine whether or not there may be something that has impacted it but not yet been recorded. So we're going to start talking about preparing the journal entries. In no instance during an adjusting process is the cash account actually used. So starting with deferrals. There's the two categories of deferrals being prepaid expenses or unearned revenues. Prepaid expenses are paid in cash and are recorded as assets until they are used or consumed. Prepaid expenses are costs that expire with the passage of time or through the use. So we go out and we pay for something today, but it's going to provide us with some type of benefit for longer than one accounting period. That is a prepaid expense. For example, when you pay for 1 year's worth of insurance, you pay out $1,200 today, but it's going to provide 12 months of coverage. That coverage extends into multiple accounting periods. Therefore, it's a prepaid expense. Now, when you purchase your supplies, they're often going to cover multiple accounting periods. So they're an asset until the point in which they're consumed. As you can see with some of these different prepayments, such as rent, the purchase of equipment, the purchase of buildings, advertising, supplies, insurance, it is quite often that we pay for something before we are going to receive the benefit for it. These costs will expire through either the passage of time or through use. We engage in adjusting entries for these types of costs, and they result in an increase, a debit to an expense account, and a decrease or a credit to the asset account. Let's just look at that using T accounts. So with the adjusting entry, what we are saying is that some amount of whatever this asset is, of a prepaid expense, has now been consumed or allocated to this specific time period in accordance with the expense recognition principle. To illustrate that, we're going to use supplies. So Sierra Corporation purchased supplies costing $2,500 on October 5th. They recorded that purchase by increasing the asset supplies. This account shows a balance of $2,500 on the October 31st trial balance. However, they've used some of those supplies in the course of the month. So there was an inventory count done at the close of business on October 31st. And it showed that there was really only $1,000 of supplies that were still on hand. The account balance is $2,500, and there's only $1,000 in supplies. Then that means that we must have consumed $1,500 worth of supplies. So our supplies expense for the month of October would be $1,500. And we would adjust the supplies accounts by that $1,500 to accurately reflect that there is only $1,000 of supplies that are still on hand. Supplies is a regular prepaid expense. It's something that you will see many times. So when you're looking at your accounts, when you're working with problems, make sure that you are choosing the correct one, whether it's supplies, which is the prepaid expense asset, or it's supplies expense, which is where we will allocate the amounts to as they are consumed, because they are very different accounts. One is an asset and one is an expense. Taking that also into consideration is, let's look at insurance. So on October 4th, Sierra Corporation paid $600 for a 1-year fire insurance policy. Coverage began on October 1st. Sierra recorded the payment by increasing their prepaid insurance account, which is an asset, by debiting it. This account shows a $600 balance in the October 31st trial balance. However, they have consumed or had coverage for the month of October. Therefore, they need to recognize the amount of used insurance in their financial statements. If we take that $600 that was remitted and divide it by 12 months, because it's a 1-year fire insurance policy, then we know that there's $50 worth of insurance that will expire as each month goes by. So we have a $50 insurance expense. That's the consumption, the expiration, the use of the asset for the month. And we reduce our prepaid insurance by that same amount. So next we're going to talk about a asset. Actually, quite a few different types of assets. Those types of assets you find in plants, property, and equipment. Things such as buildings, equipment, motor vehicles are long-lived assets. When we purchase them, we recognize them as assets because they're beneficial for multiple time periods, rather than as an expense in the year in which we acquired them. We use what's called depreciation as a means of allocating the cost, how much we originally paid for that asset, to the multiple periods over its useful life. So all the periods that it benefits us, we recognize that cost and allocate it to those periods. There is no actual real attempt to have your balance sheet reflect the true value of the asset. Depreciation does not do this. What it does is it says that X amount of dollars was invested in a long-lived asset. That asset is providing benefit, revenues for multiple periods. And we are going to just allocate what was paid to those periods. We'll go much more in depth into depreciation in a later class. Just recognize that depreciation is an adjustment that we have to do in order to recognize the expensing of the prepaid assets. So, Sierra Corporation, and we're going to assume that depreciation for their office equipment is $480 for the year. We'll get more into how all that calculates in later classes. But we're just going to say that there's an amount of $480 in a year. Take that $480 in a year and divide it by 12, and you're going to receive $40 per month of depreciation or cost allocation that is being assigned for the use of the office equipment for the period that it benefited. So we recognize a depreciation expense of $40. And in this case, we post to a special account called Accumulated Depreciation Equipment, $40. We'll get into what those accounts are more in depth, of course, later. This is an account where, as we recognize the depreciation expense, we post them into these. So the actual asset line itself, such as equipment, maintains its historical cost, and then equipment less accumulated depreciation will reflect the book value. Remember, this is book value, has nothing to do with market value of the asset at a given point in time on the balance sheet. Accumulated depreciation is what is called a contra asset account. All contra accounts have increases, decreases, and normal balances, which are opposite or contrary to the account to which they relate. It appears just after the accounted offsets on the balance sheet. So as you can see here, the representation of equipment at $5,000 historical cost, less the accumulated depreciation for equipment of $40, for a book value of $4,960. Now, some of the types of prepaid expenses that we have to adjust for are insurance, supplies, advertising, possibly, rent, depreciation. The reason that we do this is that the prepaid expenses need to be recorded as asset accounts when they're acquired and then allocated to those periods in which they benefit or have been used. The accounts before we engage in these adjustments, the assets are effectively overstated and your expenses are effectively understated. To create the adjusting entry, you will debit the appropriate expense account and credit the appropriate asset accounts.